The national debt exceeded $30 trillion.
$33 trillion.
You see the number, 35 trillion.
We have $36 trillion of debt for a reason.
The size of the US national debt is the largest that it's ever been, and over the past 2 decades, it's been growing. But then, this happened. Looking at the debt to GDP ratio, we get the same story. But what happens when a country takes on more debt than it can afford? And will the US fall into the same trap? Okay, so you're a Greek citizen in 2008, and you can see that your economy is in a bit of an unenviable position. For a decade, it's been reliant on excessive government spending and a very large current account deficit, financed by investors confident that Greece's entry into the Eurozone would help mitigate the risks involved. In the 5 years following 2008, government expenditure rose by 87%, while tax receipts only rose by 31%, leading the government into a huge budget deficit. For years, the Greek authorities were involved in some creative accounting, orchestrating currency swaps with Goldman Sachs to try and hide the true size of their debt and stay close to the Eurozone's 60% debt to GDP target. When, finally, in 2010, Goldman Sachs' fiscal manipulation was uncovered, Eurostat revised its debt forecast from 6% to 15.4%, and all remaining investor confidence was lost. Investors rapidly sold off their holdings of Greek bonds, sending yields skyrocketing. Greece's bonds were downgraded to junk status, and teetering on the edge of default, Greece was forced to accept a series of bailout packages from the Troika, where in exchange for billions of euros of loans which Greece could use to pay back its creditors, they had to implement strict austerity measures. For example, they were forced to freeze public sector wages, increase VAT by another 10%, and crack down on tax evasion. These measures were fiercely unpopular with the Greek public, causing protests, civil unrest, and a dramatic drop in living standards. All in all, the loss of confidence caused by years of fiscal indiscipline and an attempt to cover up government debt caused Greece's GDP to fall by over 25% between 2008 and 2016. At one point, unemployment reached 27.5%, more than the Great Depression. Japan is, by most measures, a well-developed and stable economy. Sure, it might face demographic challenges and sluggish growth, but living standards are high and it's got the 5th highest GDP in the world. Japan's government debt, however, makes up 255% of its GDP, the 2nd highest in the world, behind Sudan. But you never hear of a Japanese debt crisis sending the country's public finances into a downward spiral. So what are they doing right? Well, Japan's debt situation is actually pretty unique for a couple of reasons. First of all, about 90% of Japan's debt is domestically owned, as opposed to only about 30% for Greece. The Bank of Japan itself owns about 40% of Japan's debt. This means that unlike Greece, Japan is far less vulnerable to foreign investors rapidly selling off bonds at the first sign of instability. Domestically owned debt tends to be more sticky than foreign-owned debt because domestic debt holders such as central banks, pensions and mutual funds tend to have a lower appetite for risk and are less likely to make risky trades looking for short-term profits. Japan's economy has also suffered exceptionally slow growth over the last 30 years. There were a couple of reasons for this, ranging from the collapse of the asset bubble causing a fall in household wealth and consumption, to retail banks being unwilling to lend due to a lack of liquidity because they held a large stock of non-performing loans. This also made conventional monetary policy relatively ineffective, and as a result, Japanese investors, who preferred to keep their wealth in safe assets rather than increasingly risky private investment opportunities, provided a strong, steady demand for Japanese bonds. Strong demand for Japanese bonds, rather than, for example, Greek bonds, kept yields low, and as a result, the cost of servicing existing debt, or issuing new debt for the Japanese government, also remained low. Due to the Bank of Japan still being seen as one of the world's most stable debt issuers, it is probably more advantageous for the Japanese government to maintain or expand spending towards structural reforms, such as education, training, or incentivizing young families to have more children, rather than making fiscal sacrifices now to try and pay down the national debt. We've looked at the best and worst case scenario of what can happen when a modern, developed country experiences an extreme debt burden. But where does America fit into this? Over the past 20 years, the American debt to GDP ratio has almost doubled from 61% to 121%, and as of now, debt servicing costs constitute 16% of the federal budget. According to the Peter G. Peterson Foundation, debt servicing costs will soon be the largest as a proportion of the federal budget since World War II. But America isn't like any other country. Treasury bills are seen as the world's safest asset due to their extreme liquidity, and the US dollar is the world's reserve currency. This allows the US a special exorbitant privilege status, allowing it to take on a greater debt to GDP ratio than other countries would be able to, without spooking the bond market. The dollar status as the world's reserve currency ensures a constant global demand for US bonds, and the ongoing stability and liquidity of treasury bonds ensures that foreign central banks can reliably invest their reserves at scale in US debt. However, while the US is uniquely advantaged, they're not invulnerable. The bond markets can and often do react badly to rash political decisions, such as Trump's April 2nd Liberation Day. A sharp rise in bond yields, even if it's temporary, could cause significant fiscal harm to a deeply indebted government that is constantly rolling over and issuing new debt. Furthermore, the US political system over the past 20 years has become increasingly divided and dysfunctional, with the debt ceiling mechanism causing an almost biannual show of political brinkmanship, causing an almost constant, non-trivial risk of default. Debt ceiling showdowns and a uniquely American abhorrence towards tax rises has caused various credit agencies to downgrade the US from AAA to AA. And if the US were to ever default, it would almost certainly lose its exorbitant privileged status and may be forced to make politically painful decisions to cut the budget deficit. Assuming the US doesn't fall prey to a self-inflicted technical default, while its level of debt is unlikely to directly cause a default, an ever-increasing stock of debt is likely to add to the increased pressures on government finances from an aging population and a declining birth rate. However, if the American economy experiences a labour productivity boom from developments in AI, as it did from the advent of internet technology, the resultant fiscal dividends may cause a drop in the structural budget deficit. As a result, the government may decide to proactively pay off debt, and thus, barring political suicide, a rapid loss of international competitiveness in the field of AI, or some severe recession in the next 10 to 15 years, the rising US national debt is unlikely to necessitate sufficient austerity measures in the near future.